The world's financial centers reeled in disbelief, their glittering skylines suddenly overshadowed by uncertainty. A single tweet from President Trump shattered the calm, announcing a staggering 39% tariff on Swiss gold, effective immediately, with no warning or negotiation. In Zurich and London, traders watched in shock as gold prices whipsawed violently, their screens flickering with red and green. The bedrock of global finance, gold, was suddenly thrust into the heart of an economic war, its stability now in question. The New York Stock Exchange erupted in chaos. Traders shouted over each other, desperate to make sense of the unfolding crisis. The Dow plunged over 1,000 points within the first hour, erasing billions in market value in mere minutes. The VIX, Wall Street's so-called fear index, soared to levels not seen since the last major financial meltdown, signaling panic. Swiss bankers, renowned for their composure and discretion, scrambled behind closed doors, urgently reviewing their options. They felt blindsided by a trusted ally, their confidence shaken as they pored over documents and crisis plans. The Swiss National Bank stepped forward, promising stability and calm to the public and markets alike. But beneath the surface, a sense of betrayal simmered, threatening to upend decades of financial cooperation. In Washington, the White House defended the move, insisting it was necessary to force Switzerland to the negotiating table over opaque financial practices and hidden wealth. Markets, however, paid little attention to political justifications. They saw only disruption, risk, and uncertainty. The world's primary gold pipeline had just been severed. Production lines halted, vaults locked, and shipments frozen. The shockwave was immediate, and its aftershocks would ripple through economies and boardrooms for months to come. This was no ordinary trade dispute. It was a rupture in the very fabric of international trust. It was a direct assault on the machinery of global finance, threatening to reshape the world's economic order. The golden crisis had begun, and no one could predict how far its consequences would reach. President Trump's 39% tariff on Swiss gold stunned even his closest advisors. Officially, it was to address a $48 billion trade deficit and Switzerland's dominance in gold refining. But insiders reveal it was a high-stakes gamble, chosen for shock value, not economic logic. Instead of strength, the move triggered global volatility, disrupted supply chains, and made American businesses and consumers pay the price. The administration underestimated Switzerland's leverage and overestimated America's immunity to the fallout. Switzerland is the world's gold refinery, processing 70% of global supply. 4 of the 5 largest refineries are nestled in the Swiss Alps, producing the gold bars trusted by central banks and investors worldwide. The Swiss stamp is the gold standard, literally. No other country matches Switzerland's scale, technology, or reputation. The global logistics network is built around Swiss refineries. Rerouting would take years and billions. The US tariff built a wall around this system, assuming the market could adapt overnight. But there was no alternative. Jewelers, tech firms, and central banks all depended on Swiss gold. The world's reliance on Switzerland wasn't a weakness. It was the system's greatest strength. The White House had underestimated just how indispensable Switzerland was. The consequences would be severe. The tariff backfired, paralyzing US gold management and sending shockwaves through the financial system. What was meant as a targeted move quickly spiraled out of control, leaving officials scrambling for solutions. The nation's gold reserves, a key store of value and confidence, were suddenly frozen, unable to move or be traded as usual. Foreign investors, spooked by the growing market chaos and uncertainty, began quietly reducing US bond holdings, nudging up government borrowing costs and adding pressure to an already fragile economy. The intended fix for a $48 billion deficit now threatened the stability of the multi-trillion-dollar treasury market, raising fears of a broader financial crisis. Politically, the move split Republicans and fueled Democratic attacks, igniting fierce debates in Congress and deepening partisan divides. American businesses, from jewelers to tech firms, faced soaring costs, unable to absorb the sudden 39% spike in gold prices. Many struggled to keep up with rising expenses, passing costs on to consumers. The U.S. price of gold decoupled from the global market, making everything from wedding rings to electronics more expensive for ordinary Americans and fueling frustration across the country. Small businesses teetered on the brink of bankruptcy, with many forced to lay off workers or close their doors entirely. The tariff meant to punish Switzerland was inflicting real pain on Americans, hitting families, workers, and entrepreneurs hardest. The economic and political backlash was swift and growing, as protests erupted and public anger mounted. The ripple effects were just beginning, spreading through supply chains, local economies, and communities nationwide. The cost of this gamble was mounting by the day, with no clear end in sight and the stakes growing ever higher. Switzerland's response was measured, strategic, and quietly devastating. It filed a WTO complaint, framing the U.S. move as a threat to global trade rules and rallying international support. Behind the scenes, Swiss banks reviewed their massive U.S. holdings, a subtle but chilling signal to Washington. Switzerland began courting China and the EU, proposing new gold trading frameworks that bypassed the U.S. dollar. The Swiss offered enhanced security and transparency to central banks willing to store gold in Switzerland, sidestepping the U.S. system. Switzerland's leverage was trust, now weaponized. The U.S. had shattered decades of credibility. Switzerland positioned itself as a stable alternative. The counterpunch wasn't loud, but it was effective. The U.S. found itself increasingly isolated. In global finance, reputation is power, and Switzerland was winning that battle. The world was watching and recalibrating. In Geneva, U.S. and Swiss negotiators faced off, each under immense pressure. The U.S. delegation, squeezed by political demands and economic fallout, found its position weakening. The Swiss, calm and patient, demanded unconditional removal of the tariff before any broader talks. Time favored Switzerland. Every day of disruption increased global and domestic pressure on Washington. Best case, a quiet de-escalation, with both sides claiming partial victory. But trust would take years to rebuild. Worst-case deadlock, Swiss divestment from U.S. assets, and a global trade war. The standoff was about more than gold. It was about the future of global economic leadership. The world's financial system hung in the balance. The next move would shape the fate of markets everywhere. The stakes had never been higher. What began as a gold dispute, a seemingly isolated disagreement over precious metal, quickly spiraled into something much larger and more complex. That conflict now threatened the stability of the global bond market. The U.S. Treasury bond, long considered the world's safest and most reliable asset, was suddenly seen as vulnerable to unpredictable political risk, shaking the confidence of investors everywhere. The Swiss gold tariff sent a powerful message. If Switzerland could change the rules overnight, so could the U.S., making investors worldwide nervous about what might come next. In response, some foreign governments began quietly reducing their U.S. bond exposure, selling off holdings and forcing higher interest rates, which in turn raised borrowing costs for everyday Americans, from families to small businesses. What started as a small trade dispute was now increasing the financial burden on U.S. taxpayers, with ripple effects spreading across the economy. The ultimate fear: a major sell-off by countries like China, which hold vast reserves of U.S. debt, could trigger a devastating crisis of confidence in the dollar, unleashing inflation, a market crash, and even a global recession. The gold tariff exposed the fragility of the interconnected financial system, revealing just how quickly trust can evaporate. One push had set off a dangerous chain reaction, with consequences that could be felt around the world. The world was learning, in real time, just how high the stakes really were and how fragile global finance could be. This crisis forces us to confront hard questions about the future of global finance. The post-war order, built on American leadership and trust, now looks fragile. Aggressive tariffs and market disruptions have many nations questioning their reliance on the US dollar. Could this be the tipping point for a new, more fragmented world order? Countries are already developing alternatives: digital currencies, new payment systems, and trade blocs that bypass the dollar. The rules-based system is under threat. Will nations reform it or retreat into economic conflict? Even gold and US bonds, once safe havens, now carry political risk. The answers to these questions will define the next era of global trade and finance. The world is at a crossroads. The legacy of the gold crisis will shape decades to come. We've traced the shockwaves from trading floors to global politics. A single tariff has exposed vulnerabilities in the world economy and challenged America's leadership. Now, we want to hear from you. Was the tariff a bold defense of US interests or a reckless gamble? How do you see this standoff ending? And what does it mean for the future of global finance? Share your thoughts in the comments and join the conversation. The story isn't over. Stay informed, keep questioning, and watch as history unfolds.